Well, good afternoon, everybody. I'm Dave Weisberger, CEO of CoinRoutes. It's time for our weekly This Week in Crypto recap. It is Friday, September 8th, 2023. And there are two huge stories that we want to talk about this week. But first, we'll start with checking the markets. Bitcoin and Ethereum more or less around up 1% for the week, kind of still flattish. It's been up and down at about $1,000 range Bitcoin has for the week, where last night there was a bull run followed by it fell off a cliff right back retracing the lows, followed by a little bit of a retracement of half of that gain, and we're kind of in the middle of the range. Look, the reality is we've been range bound for a while. There seems to be very strong buying interest below 25.5 or so. That buying interest persists at most of these levels, but the speculators tend to blow up and blow down, and there's not a lot of movement. And without belaboring the obvious, we're still basically waiting on two huge events. There's an issue with what's going to happen with Binance. We continue to have stories that there are risks. There are people who are spreading rumors that client assets could be at risk. There are others who are saying no way, that it could, in fact, have problems from the DOJ and Interpol, etc. But really, that'll be more of an inconvenience for altcoins than Bitcoin, because the fact of the matter is there are other venues, and their market share has come down precipitously from the peak post FTX. So we're stuck in a range for trading, but there are a couple of really important news stories and several other stories this week that bear diving into. The first one is FASB, the Financial Accounting Standards Board. And they did something this week that is, and you can't underestimate the importance of this, that is a necessary change for the adoption of Bitcoin as a digital gold style store of value. I said it very clearly, necessary change, not sufficient, but necessary. For those people who believe that the odds of the digital gold narrative happening were 5% last week, this week it has to be higher, but the price hasn't moved. So in my opinion, I'm even more bullish than I was last week. So let's talk about exactly what they did. So before the actions of this week, before the announcement, if you were a corporation and you had accounting standards and you owned Bitcoin, you had to hold it on your books at the lower of where you paid for it, or where the lowest price was in the preceding period. Meaning that if you paid $25,000 for Bitcoin, it touched 15,000 during that period, and it was trading at 50,000 at the end of the period, you had to report Bitcoin as a loss of $10,000, and it was still sitting on the book at 15,000. In no point in the future could you ever take a gain. Now, as a result of that, corporate treasurers never bothered approaching their boards of directors, for the most part, to own any Bitcoin in the balance sheet, because it was so unfavorable. As a result, although Michael Saylor, the ultimate giga chad, to use the term that bestowed upon him from the crypto community, from the Bitcoin community, who basically didn't have to worry about his board of directors, turned MicroStrategies into more or less almost a pure play Bitcoin play. He held various seminars for corporate treasurers, and had 2,000 of them, many of which were excited. But when they looked up the accounting rules, they're like, oh, no, we can't touch this. So a couple of caveats here. The rule doesn't change until 2025. Not sure why, probably for various political reasons. And secondly, it won't immediately trigger an action. But as I said, it is clearly a necessary change in order for Bitcoin to get global adoption. It has to be unimpeded. You can't have things like accounting rules making it not holdable by large multi-trillion-dollar players in the market. So that is a very big piece of news, and one would expect, if markets were efficient, that Bitcoin would have ratcheted higher on that. But this market, where you have 75% of the holders being long-term, not selling, and some people accumulating slowly, and 25% of the people sitting there trading it and around it and wanting immediate gratification, not giving a crap about 2025, it didn't move the price. I'm not terribly surprised, but if you are trying to understand for a long-term investment about the value of an asymmetric upside, it just became a better bet. Full stop. Second piece of news, the IMF and the Financial Standards Board came out with a comprehensive guide toward regulation. Now, the headlines on this story are, as you can see in our graphic, are don't ban crypto, just regulate it. And of course, given the political agenda of the IMF, they're not a big fan of Bitcoin, but they are a fan of efficiencies in technology. And so whether it's crypto or the idiotic blockchain, not Bitcoin narrative or whatever, they're a little bit conflicted. But it is an important report that actually goes through 9 different sets of recommendations for crypto assets, every one of which has some rational basis in truth. And what is not in this is banning or making it impossible to use. So let's talk about what they were. I'll go through them really quickly. First one is regulate with the appropriate tools. Now, when you look at what they say, sure, they talk about being able to enforce existing regulations, but really what they're talking about is the principles underlying regulations, meaning that most of the world is kind of moving in that direction. With MiCA, the FCA is doing it. Dubai has certainly done it. Singapore, the Switzerland, their FINMA, their regulator, Hong Kong, etc. But the U.S. is still trying to use rules that don't apply, that are not appropriate tools. So it's sort of gently chiding the U.S. Interestingly enough, I would have been surprised for them to say otherwise, but they did it very gently. Second, comprehensive and effective regulation. Obviously, don't allow things to skirt around the edges. And really, what I think they're mostly talking about there is being able to apply for KYC and AML. And effectively, I've talked about this before, but people in the crypto community need to relax a bit. And there is no chance that our current government structures, unless we vote out all the current governments in the West, are going to allow people to buy stuff with briefcases full of cash anymore. They're just not going to allow it. They're going to want to know if you're buying a house, a car, property, where the source of funds was. Well, that is not going to change because it's crypto. Peer-to-peer crypto for individual transactions, individuals to each other. Yeah, that's not going to be a problem. Just like you can go to the Diamond District in New York and pay cash for a diamond. But the reality is, you want to do things on more large scale, things that have enduring property rights associated with it, they're going to check source of funds. And all this is saying is it needs to be tracked in crypto too. 3, this is a big one. Cross-border cooperation on regulations. This is something that will give people fits because a lot of the financial regulators in many countries don't work together very well. They very loose cooperation. There's differences among geographies. What they're basically saying is that's not going to work for a truly global asset. And they're right. 4th, governance of crypto issuers needs to have clearly disclosed responsibilities and accountabilities of the people who have created it, kind of a veiled inference toward owners and founders who have large token rights. Also makes sense. 5, risk management. The idea that you should take and understand what the risks to the financial system are in any crypto product. Okay. 7, ensure the integrity of data. That's kind of comical because if there's one major benefit of all crypto, blockchain technology, is the data is preserved. But hey, they had to put it in there because after all, their bureaucrats are going to put a lot of stuff in here. 7, disclosures over not just governance, but over the risks, the operations, etc. Basically, something I've talked about many times on this channel. The fact is, most regulations that exist for crypto asset or exist for regular assets don't pertain to the specific risks, tokenomics, etc., operations of how smart contracts work. Those need to be disclosed. Okay, well, that's perfectly fair for issuers. 8 is monitor the systemic risks. Okay, that's pretty obvious. And 9, regulations for multifaceted providers. Understand that not stop Coinbase from being vertically integrated, but make the regulations work for a company that is a money services business, that is also a custodian, that is also a broker, that also has an exchange and a neutral platform, that adapt regulations for lower numbers of intermediaries and less intermediation, but make sure it's multifaceted. Also makes sense. So what do I make out of all this? Actually, I think it's very important. The narrative that I think is most important for crypto regulation in the United States, for the use cases and the growth of the market, has always been twofold. One is Bitcoin as a store of value, and this doesn't really talk a lot about that. But the second one, the fact that we are transitioning eventually to a digital financial system, which will be dramatically more efficient and inclusive than the current analog financial system with all the gatekeepers and all the roadblocks that have been built up around it, is a big deal. And the IMF is essentially recognizing that the digital transformation needs to happen, is going to happen, and we shouldn't get left behind by it. That is the message that every single regulator, every single person in the United States should understand. And when we go to the voting booths in the fall, we should understand that if the United States does not recognize the importance of that digital transformation, we will be left back. And we will go from the first, the best, most efficient capital markets with 50% of the world's investable assets here to a backwater where we have the least efficient capital market compared to a digital world out off of our shores. And if that sounds hyperbolic, I'm sorry, but if Elizabeth Warren had her way, that is exactly what would happen in the United States. So voting against her anti-crypto army and her acolytes is extremely important because even the IMF agrees with me now. And that's kind of important. Larry Fink agreed with me. We've seen all this stuff, but this is a big deal. So what other stories do we have for the week? Well, we have JPMorgan introducing a new token, curiously called a deposit token. And I asked the question kind of whimsically on Twitter is what is the difference between this and a stable coin? And no one could answer me other than to say, well, because it is a stable coin. It simply is limited in its use cases to bank deposits and payments. Phrased differently, they don't have the ability or they can control its use, meaning you can't use to exchange it against Bitcoin on an exchange necessarily, unless they decide to let it. But a controlled coin using blockchain technology that gives one of the world's most powerful financial institutions control over what I can spend is probably not something I'm all that happy about. Yes, it will make deposits and payments more efficient. And yes, eventually it'll become interoperable with other less controlled entities. But it's interesting that they chose to do this because, it's the old expression, if you can't beat them, join them. But once you join them, you want to co-opt them. And it's clear that that's what they're doing here. You don't have to be playing 3D chess to figure out that's the move. But we'll see how it develops. Next case that I like is LBRY, LBRY as called in the industry, has decided to appeal their conviction from the SEC on the basis of recent court cases. I wish them well. LBRY is one of those cases that it never sat right with me or anybody in the industry that the SEC should pick on a company that had the most important thing that they did different than the rest of the industry is they actually went to the SEC and tried to work through the regulations that clearly there's no way to work through them and effectively destroyed the company. So now they have new people backing them, don't know who, and they're going to appeal. I wish them well. I think it will be good for the industry. And frankly, the notion of regulation by enforcement on old security style rules that don't work for crypto should be thrown into the dustbin of history. So hopefully that'll work. Last case before we talk about two other stories is the CFTC. CFTC came out and it turned out they settled with 3 different DeFi protocols, with 0x being one of them. The settlements were for small amounts. They were for $100,000 and $200,000 among the 3 of them each. So they were really small. And it was very, very clear that this is another case of a jurisdictional land grab by an organization. The CFTC tends to be less rapacious than the SEC, but the fact is what they're saying is simple. If you cannot have a DeFi protocol that's offering derivatives to US citizens, period. Not until or unless there is a way for it to fit within the existing realm and the existing process, which, by the way, requires forced intermediation from FCMs between clients and exchanges and requires socialization of losses at the exchange level, et cetera, et cetera. I think there is a very real possibility, as the rest of the world develops, that if these laws don't change in the United States, that the U.S. could be left behind in derivative trading as well. But we're far from that. It hasn't happened, but it could happen. And frankly, I think the CFTC tends to be more forward-looking. So under the appropriate leadership in a world where we actually are making strides towards crypto regulation, I do believe that real-time liquidation, that actual engines such as being pioneered in crypto, provided that assets can be audited and understood, provided that risks can be overseen and surveilled, can work in the United States, will work in the United States, and won't take decades, but we're not there yet. And so now the U.S. is going to be left behind, and that's very clear. So let's conclude with a couple of funny stories, and funny in the sense of not to the individuals involved, but amusing when you look at the scale of things. First is in Turkey, we saw a prison sentence handed down for, I guess it was over 11 millennia, for the operator of a failed exchange. Yes. If you operate a failed exchange and people lose money in crypto in one of the most highly active crypto markets on the planet, you are going to face severe retribution. I think that's good in a sense. I mean, obviously, no one's going to be in jail. You're not going to keep someone's bones in a prison for 11 millennia unless you're looking to create a fossil record of them. But the truth of the matter is that if you commit fraud, and I have no notion of the case whether the person actually did commit fraud or not, or just lost money, but if you cause clients to lose assets when they thought their assets were otherwise safe, yes, there should be penalties for that. And those penalties should be severe and severe enough to dissuade people from taking the risk to do it. Which brings me to the last story. Another one of the FTX gang pleads out guilty, Ryan Salame in this particular case. And in his case, it's a big deal. He is forfeiting over $1 billion of disgorgement, as well as other properties, other things in the case. And you can read about it. But the reality is it looks at this point like Mr. Sam Bankman Fried is alone. And who knows? Maybe he'll be able to have bought off the jurors. Maybe his political influence will get him something different. But from where I sit, the image of all of these people in orange jumpsuits being walked in and out of court would be healing for the community. The fact is that we are still recovering from the largest exchange, the one that was the most used by the professional community, the one that we saw patches on the umpires of Major League Baseball all throughout the playoffs and World Series. We used to have a stadium in Miami named after them. The largest single donor to the political system in the 22 elections. That firm using customer funds to do all of that is an image that's going to be a long time being shaken from the minds of the average citizen. It would be a good thing for all of this to be put behind us. It's just another story. It isn't moving the markets, nor should it, but it's one that I, for one, can applaud. So that's it for this week. Let's see if anything else happens next week. I frankly doubt it. I think next week we go into the so-called quad witching. For old timers like me, I still remember triple witching. And for those who don't know what that means, it means that the options on individual products, the options on indices, the futures on indices, and futures on individual products are all expiring next Friday throughout the financial system. And that tends to cause a lot of gridlock in the time period leading up to that. At the same time, the first half of September has traditionally been kind of a dead period for crypto trading as well. This is one of the reasons, and we'll see what happens after that. I suspect that after we get past next weekend and we get into and past the Jewish holidays, which also tends to suppress volume, we could see some interesting action as we get toward the end of the month and into October. But for now, let's just enjoy the relative calm, stay safe out there, and enjoy your weekends.